Okay, now we're going to change gears and talk about a sector where numbers will start on Thursday. There is TCS, then there is Infosys. Infosys stock not far away from an all-time high. For the year gone by, IT has been in performing sector. Who would have thought that in middle of AI disruptive wave, IT companies could actually make a comeback. Stocks could make a comeback. Profits have not made a comeback. Upgrades have not made a comeback. But yeah, markets feel that 2025 will be a better year for IT companies purely because of this entire downturn which happened because of AI that seems to be stabilizing. Sandip Agarwal joins us, fund manager with Swalino Investment Managers. Sandip, uh, are we in for a surprise? Are we in for a disappointment? What should be the broader tone of IT numbers this earnings season?
Yeah, hi, good morning, and thanks for having me on the show. So I would just simply say that, what is built in the price that is most important. So last year around this time, all the stocks were at like 5-year low on the multiples. There was immense amount of fear that, AI will disrupt the whole industry. And whenever a new technology has come, I have seen in last 30 years, 7 times almost, that Indian stocks, large caps have corrected a lot and then they recover. So remember, we are the software factory of the world, so we have to provide manpower. That should be at the back of mind when we are seeing the sector. But at the same time, this is now a matured sector, and the growth expectation for large companies for the large cap should not be more than 8-10% in long run on an average, and with some benefit coming in because of EPS growing faster than the revenue growth, primarily because of the buyback. And at that stability and cash distribution, what is the multiple which one should be willing to give? So I believe that that was the time last year around same time was the time when the sector was making a bottom. Most of the large companies were withdrawing their offer letter from the campus. They were stopping the variable pay and all. And since then, we have seen the sector doing extremely well. I think now what is happening is that all the positives which will happen in next 2-3 years because of tax cut in the US and everything is built in the stock prices. But what is not built in is the cost of doing business. So my fear is that if there is some cost which goes up in an indirect way, not tariff but something else, more localization or something, then that cost is definitely not in the stocks today, and that gives me jitters that we are priced to perfection right now in most of the stocks in the sector.
What is your anticipation then for the quarter ahead? Because, for now, going through all the brokerage notes, it seems like it's going to be a mixed bag. For a price to perfection, perhaps Persistent and HCL Technologies, it seems that they're going to lead actually the sequential revenue growth. But Wipro is expected to remain a laggard. For HCL Tech, guidance perhaps could be upped, and Infosys perhaps guidance could be narrowed when it comes to constant currency term numbers. What are you penciling in? And let's start off with the large caps first.
So, this quarter, as you rightly mentioned, there is a impact of cross currency also between 60 to 100 bips across companies based on their exposure on different geographies. So which means that the constant currency growth will be higher, but the actual reported will be lower because there is a negative impact. I think that HCL and Persistent and Firstsource be the ones which probably will have better numbers in terms of growth. HCL primarily because there is a seasonal impact also, and Persistent being in the ER&D space, and also they are winning a lot of orders, so they are doing relatively well. But broadly, other companies, I think most of them you will see very limited growth quarter on quarter, further impacted by the cross currency impact. So and on margins, I think there will be some benefits for some of the players where growth is good, like HCL. They should also see some margin expansion. But this is a seasonally weak quarter because of holidays, primarily the furloughs in the manufacturing side. So we have to cognizant of that fact also. So I believe that there is a price to perfection which is already there in the stock, and I don't see much excitement in the numbers honestly. And what we have not built in is the risk or the cost of doing business, which can go up once a new president takes over.
Sandeep, given all of this, what are you recommending your clients to do within the IT pack right now? Sell out because, as you said, it's priced to perfection, or there are still some stocks in niche areas that you would recommend as a buy?
So see, we run a PMS, so calling out any specific stock will be difficult, but let me give you a flavor. We believe that, ER&D is a very, very long-term, a decadal theme, at least, if not more. And in that space, whenever we find something which is attractive on valuations, and remember when I mean attractive, it is relative, because you won't get ER&D companies at valuation of IT services companies. So you have to pay at least 2x multiple for them versus IT services. So that is where, we keep accumulating and we keep looking at stocks, because we believe that it may look expensive in 1 or 2 year horizon, but from a 10-year perspective, a lot of money is to be made in that space. In the IT services, we are always value buyers, so we try to buy stocks which are reasonably priced. Unfortunately, right now there are very few names which are reasonably priced. So we are right now shifting more towards the technology domain selection criteria rather than the valuation criteria, because valuation criteria is now not meeting our requirement. It is very expensive. On the technology side, ER&D is something which we are favoring a lot, and wherever we get good ticks within that, we try to accumulate that.
Sandeep, TCS and Infosys is something that had, kind of obviously was part of most of the portfolios. But if anyone is looking at buying incrementally, it was the names like, Wipro or Tech Mahindra or LTI Mindtree, which were the underperformers and weren't part of the historic portfolios. Do you see that kind of churn continuing, all of these underperformers or the less valued stock getting more preference from investors?
So in last 6 months, if you see two stocks which were massively undervalued, TCS and HCL, they have done phenomenally well. So now, there is not much value left there. Similarly, Infosys has moved up from 1400 to 2000 straight. TCS is the only one which has moved like 400-500 rupees. But again, because of its size, the growth in TCS cannot be compared with the small companies. So I believe that, most of the companies have run up a lot in last few months, barring TCS, which makes a case that, if there is any positive surprise on TCS, there could be some good momentum. Otherwise, in the large names also, honestly, finding value right now is very difficult.
Point taken. On that note, Sandeep, we let you go. Thanks so much for making time and speaking with us.
If you like this video, then like, share and subscribe to ET Now.